Imagine this. You haven't sold your home, your stocks, or your business, but the government still sends you a tax bill. You haven't pocketed a single cent, but now you're forced to pay tax on profits you haven't even realized. Sounds insane, right? Well, this is exactly what certain US politicians and others are currently proposing ahead of the next US election. So let's break down why this policy might sound like it's targeting the wealthy, but in reality, it could cripple the economy, hurting regular investors, small businesses, homeowners, and even innovation itself. All right, before we dive right into it, let's quickly define what an unrealized capital gains tax is. Currently, you pay taxes on capital gains when you realize them, meaning when you sell an asset like stocks, real estate, or a business. You pay taxes on the difference between what you sold them for versus what you bought them for. The tax applies to the profit you made from the sale. For example, if you've purchased stocks worth $1,000 and over time those same stocks have grown to be worth $5,000, once you sell them, you pay taxes on the $4,000 of additional value that those stocks are worth. But an unrealized capital gains tax flips that idea on its head. If such an idea is passed, you'd have to pay taxes on the increase in value of an asset before you've sold it, based purely on its market value going up. So even if you haven't seen a penny of that profit, you're still being taxed as if you have. At first glance, you might think, who cares? It's just billionaires getting taxed on their stock portfolios, right? But the reality is an unrealized gains tax doesn't just affect the ultra rich. It could hit anyone who has a retirement account, a pension fund, or an investment portfolio. And that's a lot of regular people. Let's start with the basics. Most of us invest for the long term. You put money into the stock market, let it grow over time, and eventually when you retire or need that cash, you sell your stocks. Under this new tax, the government could demand a cut of your portfolio's growth every year, even if you're not cashing out. Forcing investors to liquidate just to pay taxes would distort long-term strategies and could cause a cascade of selling, triggering sharp drops in the stock market. When millions of investors do this, you're looking at a market crash that hurts everyone, possibly toppling the economy. And don't forget, pension funds, which rely heavily on long-term investments, could collapse in a similar fashion. If these funds are forced to liquidate investments to pay taxes on gains they haven't even realized yet, that puts retirees' savings at serious risk. What sounds like a tax on the wealthy could in fact devastate middle-class workers relying on pension funds who have saved for years, only to see their retirement evaporate before their own eyes without them even cashing out any of it. Now let's talk about small business owners. Let's say you run a small coffee shop or a family-owned tech startup. You're growing your business, investing in your operations, and trying to build something sustainable. That's great, until tax season rolls around. Under an unrealized gains tax, you could be forced to pay taxes on the increased value of your business even if you haven't sold it or don't have the cash flow to cover it. Putting this into a more digestible perspective, let's say you opened up a restaurant with $100,000 of startup capital. You leased a place, cleaned it up, renovated, added your brand to it, and started selling. Once you pay for your workers' wages, you use your remaining profits to reinvest in the business, which makes its value go up. The value of your business goes up even further as you establish rapport with customers, get known in the community, and gain regulars who value your brand. Suddenly, your business is worth as much as $500,000 without you increasing your monthly cash flow much at all. And then, the end of the year rolls around and the IRS comes for you. You are now asked to pay taxes on $400,000 that your business has gained on paper, but you don't have the cash for it. Not nearly enough. Considering that the rate would probably be hovering around 25%, it would be as much as $100,000. You are forced to either sell the business to be able to afford to pay the tax, or shut down completely, losing the jobs of all the people that worked for you, the servers, the chefs, the cleaners, etc. For small businesses, this is a nightmare scenario. Unlike large corporations, small businesses don't always have liquidity to cover sudden expenses like this. They might be profitable on paper, but their cash flow is tied up in operations, employees, and reinvestment. This kind of tax could force owners to take on debt, sell off parts of their business, or in worst case scenarios, close down entirely. And who gets hit the hardest? The little guys, the mom and pop shops, the local stores, the small entrepreneurs trying to make it in a competitive market. These aren't billionaires. These are people trying to stay afloat. This is not to say that billionaires would be unaffected. Whether we like it or not, millionaires and billionaires are the people responsible for creating the vast majority of jobs, not just in the US economy, but throughout the world, and a tax policy such as this would force them to take on debt, shut down, sell, or cut back on jobs, just like the mom and pop shops, just on a much more massive scale. Think this policy won't touch you because you don't own stocks or a business? Think again. If you own a home, especially in an area with rising property values, you could also be on the hook for an unrealized gains tax. Let's say your house has appreciated in value over the last year. Under an unrealized gains tax, you'd be expected to pay a tax on the increase in the value of your home, even if you're not selling it. And where do most people store their wealth? In their homes. But here's the problem. Unless you plan on selling your home, how do you come up with the money to pay this tax? Most middle-class families don't have liquid cash just sitting around. You could be forced to take out loans or dip into savings just to pay taxes on profits you haven't seen a dime from. This could especially hurt retirees, many of whom are living on fixed income. They might own valuable homes that have appreciated in price, but they don't have the income to cover a massive tax bill. In the worst cases, some homeowners could be forced to sell their properties, adding instability to the housing market. But it's not just about individuals. An unrealized capital gains tax could have a chilling effect on innovation and entrepreneurship. Take the tech industry, for example. Startups rely on investments to fund growth, and early-stage investors are often willing to take on risk because of the potential for huge returns. But if those investors are taxed on the paper increase of their investments year after year, even if they haven't sold a single share, it could discourage them from putting money into new ventures. When investors have to pay tax bills on profits they haven't even realized, they'll think twice about taking risks. This is bad news for the broader economy. Innovation thrives on risk. Industries like technology, renewable energy, biotech, they all rely on risk takers willing to fund new ideas. If you tax those gains before they're realized, you're taxing the very thing that drives progress. Not only that, but many roads to wealth, such as Silicon Valley tech startups, would be completely obsolete. Most famous social media sites, video game developing companies, entertainment companies, and just about anything dealing with the digital world has had its start as a startup relying on debt to finance its operations. The owners of these businesses tend to have massive net worths, even though they basically have no cash or liquid assets. They are just rich on paper because their company is expected to make profits sometime in the future, but sometime in the future isn't now. And the tax bill, in this case, would come now, forcing someone who has millions of dollars on paper, while in reality he has barely anything, to pay taxes on the money he doesn't yet have, bankrupting both him and his startup. So what does this all mean? On the surface, an unrealized capital gains tax sounds like a way to make the rich pay their fair share. But in reality, it has far-reaching consequences that could hurt ordinary investors, crush small businesses, destabilize the housing market, stifle innovation, and destroy the middle class. We need to ask ourselves, do we really want to punish people for potential gains they haven't even realized yet? Or should we focus on policies that encourage investment, growth, and opportunity for everyone? At the end of the day, this tax could weaken the economy at its core, and the people who suffer the most may not be the ones you think. So before we embrace the ideas that seem to target the rich, we need to think carefully about the ripple effects and who really ends up paying the price. Thanks for watching. If you found this video insightful, make sure to like, share, and subscribe to Beyond Economics for more deep dives into economic policies shaping our world. What are your thoughts on unrealized capital gains tax? Please don't hesitate to tell me in the comments, and I'd love to hear from you.